Good day, everyone. In today's class, we are going to be discussing capital budgeting decision, which is also known as capital expenditure or capital investment or investment appraisal. In corporate finance, there are three core decision areas, including investing decision, dividend decision, and financing decision. So, one of the key decision areas in financial management is what we want to discuss, which is investing decision, which means that before a company commits its adding financial resources into executing a project, there will be need for the project to be evaluated before the final decision is taken. Therefore, when you talk about capital budgeting decision, it involves the process by which an organization commits its funds into long-term projects. Long-term projects are projects that span over one accounting period. That is, the project that will last for more than 12 months. Those are capital budgets or capital expenditure. Examples include the constructions of roads, dams, bridges, refineries, or even office building or owner-occupier building. Okay, so all these kind of expenditure are capital in nature, and they will last for more than 1 year to complete. And that's why it is called capital budgeting or capital expenditure. It is expected that a responsible management of a company will do well to create value for the company, which we believe will invariably maximize the wealth of the owners. As a result, company will need to ensure that the potential projects or the prospective projects have the capability to enhance the value of the company by ensuring that the project is appraised before the limited scarce financial resources is committed into the project. Therefore, what are the procedures involved in capital budgeting decision? There are 6 different steps an organization can embark upon or can undertake when taking capital budgeting decision. The first procedure is the identification of viable projects. Okay, which means that the company must scan the business environment to be able to identify which investable opportunities are available. All right, there are key departments within an organization that are responsible for scanning the business environment. For example, depending on the size of the company, it may be marketing unit of an organization, it may be research and development unit, it may be business support or business services unit within the organization, depending on what it is called in the company. So these departments are responsible for scanning the business environment to be able to identify the investing or potential project that the company can commit its funds upon. Now, of course, there are a lot of activity that we go into doing that, but the bottom line is that as soon as the investable opportunity has been identified, management will need to be informed. First thing first, a meeting will be convened, management meeting will be convened, and then all the directors, including the marketing directors, so responsible for that unit. So they present their the outcome of their findings to the management. It will be discussed in that meeting. And then again, of course, the lead of that department, which in this case may be marketing department, we need to write to the management in form of a memo documenting the findings and all of and the investable opportunity that have been identified. So in that meeting, the finance director will also be required to go ahead and evaluate the project to confirm uh, that the project is financially viable. Of course, the finance department is responsible for doing this, okay? So which will take us to the second step, which is the evaluation of project, okay? The second procedure is evaluation of the project. So once the project has been evaluated, of course, this is where you have responsibility. Either you are a financial analyst, financial accountant, financial manager, financial supervisor, or finance director, finance, whatever your role, or even the chief financial officer, whatever your role in that finance department. So you are going to contribute into the evaluation of the project. So if the project is financially viable using relevant investment appraisal technique, then of course, again, a meeting will be convened. The management meeting will be convened. The finance director will need to present to the management team about the outcome of the evaluation. So if the project is financially viable, management will need to, the finance director will advise that the project should be undertaken. But if it is not financially viable, of course, to be advised not to be undertaken. Take into consideration all other qualitative factors, okay? All other qualitative factors that the company will need to consider before the final decision is taken. However, if the project is financially viable, to take us to the next step, because the finance director, being an expert in the evaluation, has already recommended to the management that the project should be undertaken. Therefore, with the management, we need to authorize and approve that the project should go ahead. So this will take us to the next step. The next step is authorization and approval of projects. Okay, so there may be more than one project available. So in that, what that means is that if all the alternatives, the various projects are viable, of course, one of them will have to be taken, especially if the company does not have sufficient financial resources to undertake all the viable projects. So this is what is called capital rationing. It's a different topic on its own. When we get there, we can be discussing more on that. However, since the management or the designated authority has provided a no exemption taking on the investment opportunity that have been identified and evaluated, then of course, because it is believed that this will increase the value of the company. So management has no choice except to approve it that the project should go ahead, except that if the financing is not available, it's not readily available, okay, the funds needed to execute the project, if it is not readily available, there may be an option to delay at a later future date and all of that. Again, that's a thing, is a topic on its own. How to finance a project, okay, it's another area of financing. Okay, sorry, another area of corporate finance or strategic financial management. Then, since management has authorized and approved that the project should go ahead, that means funds will be made available. Therefore, you need to mobilize people and equipment to site. This will take us to the next step. The next step is developing and executing of projects. Okay, at this point, you need to mobilize people and approval. Since management approval has been gotten, so and then that's the, of course, at this point, you now see people on the site. So the contractor will have his own people, will mobilize and equipment. I mean, mobilize different kinds of equipment. The work has begun and all of that. So a whole lot of activity will be going on the site. So not only that, the company will, even though the contractors has his own personnel on site. Then the company will also have his own representative on site to monitor the activities of the contractors and the people and the equipment as well, to also ensure that the safety and security of people and equipment on site is guaranteed. So that's for developing and executing of project. Then after this, it is not sufficient for the company to have committed the hard-earned financial resources into executing the project. The company must ensure regular monitoring and controlling of the project. So that will take us to next step 5. So monitoring and controlling of projects. So at this point, it is not just about cost. The company will need to monitor the activity of the people and equipment on site. How are the contractor performing? The contractor has quoted in the contract agreement that they are going to do so much. They will need so much quantity or so much bags of cement and all of that. How do you ensuring that the mix of material that the contractor has quoted in the contract agreement is what they are doing? So for this purpose, the representative of the company, the engineers, the the embedded engineer in the business that the company has sent to the site must ensure that they follow what the contractor is doing. When the contractor is starting work on a daily basis, these engineers, these quantity surveyors, these architects, all of them must be present on site to ensure that what the contractor is doing is the right thing. And then what he has quoted in the contract is the same thing that he's doing, so that you don't receive shoddy job, so that the company does not receive shoddy jobs. Or not only that, if substandard materials are used, it can impair, it can damage the image of the company. Not only that, it can even result to fatality. So in order to prevent all of this from happening, it is important that the company monitor the activity of the contractor on site. Not only that, remember sometime about some years ago, about 2 years ago or thereabout, there was a particular company in Lagos. We call it Ikoyi Gate. When the incident happened, it was called Ikoyi Gate. So during this period, uh, Lagos State government gave an approval for construction of a high-rise building, okay, high-rise building for 15 floor, okay. Then the contractor, I mean the owners of the property extended it beyond, extended it to 21-story building, and as a result, the building caved in and collapsed. The owner of the property died. Some NYC the youth service, the corpers that are on site on that day, they also died. Not only that, all the workers, the artisans, all of them that are present on that day died. The owner of the property was talking, was speaking with one of his friends that is about leaving Nigeria to abroad. Okay, he was on his way to airport. He just said, let me say hello to my friend on site. Both of them, where they were talking, the building collapsed on them. It's a very serious, grave casualty as at that time. So you need to guide against all of these things. That's why it is important to monitor the activity of the people and equipment on site. That is on one side of the monitoring. The controlling part of it is that the financial resources is not sufficient. Therefore, this project has been budgeted for. How do you ensure that you do not overshoot your budget? So in this case, again, the finance department is the one responsible, okay, by monitoring, or the one responsible for monitoring the cost of the project. So by so doing, you need to prepare what is called a stewardship report or project status, whatever you call it as a company. So by monitoring the spend, you compare the spend versus the actual spend versus the budgeted amount. Or you also have the forecasted or projection, okay, projected estimate, okay. You compare that with the budget. So from on a monthly basis or on a regular basis, you must ensure that you don't overshoot your budget, because if, say for example, the duration of the project is about 5 years, so it is not that you are going to spend the entire, say for example, the project cost is 10 billion naira. So it's not that you are going to spend all the 10 billion naira within a year. So this 10 billion naira may be spread over the useful life, over the duration of the project. So every year you know how much will be spent. And of course, the amount spent on the project will be consistent with the activity of the project, that is with the scope of this project, because it is the activity of the project that will be driving the cost. It is not compulsory that everything will not be every year evenly spread. Maybe for example 2 billion naira every year. It doesn't work that way. It is the project activity that will be driving the spend on the project. So It is important when when the company is about uh, to meet, I mean to spend, when the actual spend is about to get to the budget, you need to raise alarm. You need to tell the management. In fact, on a regular basis, on a monthly basis, you must inform the management on how the project is doing. Okay, all those activities. Of course, as a finance director or as a project accountant, from time to time, you are going to be working with the project team. You work with with the project manager, the project engineers, and all of that to get information about, because they know they know the status of the project. They know more about the project activity than you do, and that's why it is important for you to work with them, get those information, so you can speak through the numbers. It's not just all about, once in a while you can go to the site to check the project status, to see the activities of what is being done. All right. So you can't just sit in the office as a project accountant or as a finance director, you just be throwing numbers here and there. Once in a while, you go to the site, know what is happening, and then again, you incorporate it so that when you are presenting your project status or your stewardship to the management, you can talk through it. So that will earn you more respect among your project, among your team. All right. So that is as per monitoring and controlling of project. Then the last one is the post-completion investigation or post-completion audit. Okay. The essence of post-completion investigation is for the company to ensure that the objective at which the project is being done, I mean, is being conducted, I mean, has been achieved. The objective, the purpose for which the project is being executed has been achieved. So the post-completion appraisal of the project provides a mechanism whereby experience gained from the current and past project can be fed into the organization decision-making process to aid decisions on future projects, which simply means that, of course, during the course of executing the project, there will be mistakes here and there. Okay, there will be mistakes here and there, and our project manager will certainly is going to commit an error, will make error during the course of the project. So this project manager should not be penalized as a result of that. Rather, there should be lessons learned from that mistake so that going forward, you don't repeat the similar mistake. So the essence of that, once the lessons learned is being documented, is being archived, then of course that will certainly aid the organization learning. That will aid the organization learning. So that is, and then again, not only that, in addition to that, it may well be that part of the scope, I mean, part of the job done by the contractor is defect. Okay, there is an error somewhere, or maybe somewhere is leaking, and of course the project has been completed. You now discover that after the completion, some area there's a defect in a particular area of the job done, or there's a leakage somewhere. So you need to call the contractor to come and fix the leakages or to repair the defect. And that's why in a contract, that's what is called a retention fee, because it's not the entire contract price that the company will pay to the contractor. There will be a very insignificant amount or percentage that will be retained in the business. It could maybe 2%, it could be 5% of the contract price that will be retained until maybe after a specified future date, maybe 6 months, maybe 1 year, maybe 2 years after the project has been completed. The essence of that is to ensure that in case there is any defect, or in case there's any defect after the project has been completed, you can you can recall the contractor to come and fix it. Because if the contractor has completed 100% of his contract's money, there will be no motivation for the contractor to come back and repair it again. So these are the procedures you need to consider when you are taking capital budgeting decision. So the next thing we want to discuss is the characteristics of capital budgeting. So when you have the material, you can just go through all of that I've discussed so far. Then let's talk about the features of capital budgeting. So the following are some of the key characteristics of capital budgeting. Number one is that it involves huge capital outlay. When you talk about capital budgeting or capital expenditure, a huge sum of money is required. Imagine a company wants to construct an office building. A company wants to construct an office building. Say, for example, even if it's not high-rise building, office building, it will cost a lot in today's price. So generally, it involves huge capital outlay. Imagine a government that wants to construct a dam, okay, a country that wants to construct a dam or bridges. You can imagine how much it will cost, even roads. You can imagine how much it will cost the government to do all of this. So that is anything that has to do with capital expenditure. It will last, that will last for more than 1 year. It will involve huge capital outlay. Then the characteristics of second characteristic of capital budgeting is that the benefits will accrue over a long period of time. The benefits arising from the investments or the project will accrue over a long period of time. At the beginning, okay, when the company will just be spending money on the project, no much benefits will be turning in, will be coming in until maybe after the completion of the project. Then the project will now begin to generate cash flows. It may be maybe after the first year, it may be even immediately, it may be immediately after the project is complete, maybe the first year after the project is completed, the project starts generating cash flow. Whatever the case, it is believed that the benefits will accrue over a long period of time. Say, for example, you have an owner occupier building, that is your own building that you want to, your residential building that you want to live. Maybe, for example, you have a duplex, then you now have a rented apartment behind. So the benefit, the rental income that the owner of that building will earn from the tenancy, of course, will accrue every year. The owner of the property will be earning that benefit, that rental income, okay, until death, or until maybe the property is sold. So that's why we are saying that the benefit will accrue over a long period of time. All right. Then the third characteristics of capital budgeting is that, of course, it involves irreversible decision. What this simply means is that once you have signed, okay, expressly signed the contract agreement, there is no going back between the company and the contractor. All right, because if the company says it's not doing again, of course, there will be penalty, because the contractor will say that, okay, I've mobilized equipment to sites, I've mobilized people and equipment to sites. All these equipment we have on sites is on, is on loan, and we are paying interest. So if the company fails to settle the contractor or to compensate the contractor, there will be litigation. Once there is litigation, the reputation of the company may be impaired. So as a result, every company wants to guide against that. And that's why generally capital budgeting involves irreversible decision. You can't change your mind that you are not doing again. All right. Even if it's contractor that says that it's not more interested, it's not doing again, there may be a form of compensation that will be paid to the company as a result of that. Okay. So then the next characteristic is that the profitability of the business concern is dependent on the large investment made in the project. So the more investment that is made on the project, the more profitability the company is likely to earn, all things being equal, ceteris paribus. Then the next one is capital budgeting is considered to be very risky. Okay, capital budgeting decision is very risky. So you imagine what I told you the other time about a building that collapsed, the high-rise building that collapsed. You can imagine most of the money spent to construct that building to the stage that it collapsed were people's money. My money, your money that we put in the bank. Those money, the funds were borrowed from the banks. And then again, of course, you can see now all those money is gone. It's gone. You can't recover it again because the building is already collapsed. In fact, the state government has already cordoned off the place. Nobody should work on the site again. In fact, the entire building now has been crushed to dust. In fact, the second high-rise building beside the collapsed building, the government wanted to demolish it, but the investors The investors and creditors, they are saying that no, government cannot do that. The case is in the court, okay, because the owner of that property that collapsed or have already borrowed money from the bank, and the creditors are saying that, okay, we have lost so much money on this, we want to collapse the other one. So the issue is in the court and they are still dragging it. So, but again, what we are saying here is that it is considered to be very risky. The risk, it can involve financial loss. Financial losses is a risk, it's a risk on its own. Reputational damage is a risk on its own. You can imagine if the owner of that building were to be alive today, how is it going to face the family of the people that lost their lives? Okay, how is it going to face the creditors? All right, how is it going to face the government? So all of that, so it's a risk on the image of the company. It's a these are the things you need to consider as far as all of these futures are concerned. Okay, so the next thing we want to do now is to discuss the methods of project evaluation. Okay, let's discuss methods of project evaluation. This is where you have the major work. Okay, this is where you have the major work. All right, now basically what is important is that when a company wants to make investing decision, it is important for the company to appraise the project to ensure that the financial resources is not lost and the financial resources is protected, because that financial resources is not sufficient. So by ensuring that the project is evaluated, we enable the company to know that the project is financially viable before committing the funds into executing the project. So as a result, there are basically two methods that you can use to evaluate a project. There is discounted cash flow method. There's also non-discounted cash flow method. The discounted cash flow method is a method that takes into consideration the timing of cash flow and the time value of money. Okay, the timing of cash flow and the time value of money over the life of the project. Okay, what that simply means is that what the time value of money connotes that the value of 1 naira of today is worth more than the value of 1 naira of tomorrow. Why? Because of price level changes, because of inflation. You know, inflation will impair the value of money. As a result, the investor will prefer to have their benefit now rather than keeping it into the future. If they have their benefit now, they can invest it on something else, okay, to earn return instead of delaying their benefit into the future. All right. So that is the concept of time value of money, which states that the value of 1 naira of today is worth more than the value of 1 naira of tomorrow. Okay. Yes. Under discounted cash flow method, there are some techniques that you may use to evaluate a project. One of them is the net present value, okay, which we are going to discuss at a later time. So we have net present value, we have internal rate of return, we have modified internal rate of return, we have project duration, we have discounted payback period, we have profitability index or benefit cost ratio, then we have adjusted present value. So all of these techniques, we are going to treat them as we proceed, especially the profitability index or benefit cost ratio. When we get to capital rationing, we are going to discuss that in details. However, in this particular class, under capital budgeting, step by step, we are going to talk about net present value, internal rate of return, all the techniques I've already identified here, apart from the profitability index. Of course, I've taken time to separate adjusted present value as a subtopic under capital budgeting, which we are going to treat at a later date. Okay. However, let's talk about the non-discounted cash flow technique before we begin to talk about all these techniques one by one. So under the non-discounted cash flow technique, we said it's also known as traditional method or conventional method of investment appraisal. It's a method that does not consider the timing of cash flow and the time value of money. So for the non-discounted cash flow, the techniques, okay, the techniques under the non-discounted cash flow method include just two, which is one, the payback period, then two, accounting rate of return. Payback period, then accounting rate of return. So these are the two methods. These are the two techniques under the non-discounted cash flow method of investment appraisal. So now let's take it one after the other. Let's take it one after the other. The next thing we want to do, okay, the next thing we want to do now is to explain each of these techniques one after the other. Okay, let's explain each of the techniques one after the other. Then let's talk about, of course, we are starting with discounted cash flow methods. So what do you understand by net present value? Simply put, NPV represents the difference between the present value of cash inflow and the present value of cash outflow in capital investment. I repeat, the net present value represents the difference between the present value of cash inflow and present value of cash outflow in capital investment. The NPV is adjudged to be the overall investment appraisal technique. Why? Because it's a technique that is consistent with the shareholders' wealth maximization objective. It is believed that a positive NPV will increase the value of the company and which will invariably maximize the wealth of the owners. All right, so it will invariably maximize the wealth of the owners, and that's why NPV is considered to be the best of all investment appraisal techniques. Okay, so that's that. Then, of course, what are the advantages and disadvantages of NPV? So you can just read that through. I can't be telling you this, so you can read them through the material. Then, how do you calculate the net present value? There are two ways in which you can calculate the net present value. You can use tabular method. You can also use formula to get your NPV. Okay, you can use tabular method or you use formula to get the NPV. Therefore, to get the NPV using tabular method, of course, remember what I said. I said NPV is the difference between the present value of cash inflow and present value of cash outflow. So the difference between the two will give you the net present value, which means that you are going to start when you want to get your NPV. You first things you start from the present value of cash inflow, then you net off the present value of cash outflow. The difference will give you the NPV. Say for example, I want to calculate NPV using these hypothetical numbers. We are going to create about 5 columns. All right, the first column will be for the year, the second one will be for description of items, the third column will be for cash flow, then discount factor, then finally the present value. Remember, our definition says that NPV is the difference between the present value of cash inflow and the present value of cash outflow. So in this case, in year zero, that's the beginning of the project. So the company will incur initial outlay. The initial cost of the project at the beginning, say for example, is 1,000. All right. So you are going to calculate discount factor at year zero. Discount factor for year zero at 10%. Say for example, our discount rate is our cost of capital is 10%. You know, cost of capital is a topic on its own, something we have done previously. Therefore, in this case, for me to get my discount factor, I would then say discount factor, say for example, for year one, okay, discount factor for year one equal to, let me first do this, discount factor equal to 1 plus R raised to power minus n. So that's the formula for calculating discount factor. So if I will now want to do for year one, where we are told our cost of capital is 10%, therefore 1 plus 10% is 0.1. Okay, so 1.1 raised to power n is year one minus 1. So this will give me 0.909. If I want to calculate discount factor for year two, I would then say equal to 1.1 raised to power minus 2. This will give me 0.826. That's how you are going to do for all of them. If you have up to year 10, that's how you are going to be doing it. Just be changing the n, 1 minus minus 1, minus 2, minus 3 till you get to minus 10. So we are saying that we are assuming that the cash flow in year 1 is 550. When you multiply 550 with the discount factor of year 1 of 0.909, this will give us 500. Then if you multiply cash flow of year 2 of 615 by the discount factor of year 2 of 0.826, this will give us a present value of 508. Therefore, when you want to get your NPV, you are supposed to add together the PV of the positive present values. You add up the positive present value before you net off the negative present value. So 500 plus 508 will give us 1008. 1008 minus 1000 will give us positive 8. So that is for NPV. That is how to calculate NPV using the formula, using the tabular method. However, if in the question, or if you want to use another method, if you want to use formula to calculate your NPV, then in this case, this is the formula you are supposed to use. The C1 is the cash flow of year 1. CF1 is the cash flow of year 1 divided by the discount factor of year 1. Cash flow of year 2 divided by the discount factor of year 2. Cash flow of year 3 divided by discount factor of year 3 till you get to the final year. So the final year is the cash flow. This is the cash flow of the final year plus the discount factor of the final year. So you add all of them together. All of this, you add them together. You add them together. Then you now net off the cash outflow. Okay, the cash outflow is for year 0. For example, in this one, if I want to use this hypothetical number that you have here, what I will just do, the cash flow of year 1 is 550. Okay, I will say 550 divided by discount factor of year 1, 1 plus r raised to power 1. So discount factor of year 1 will be 1.1 raised to power 1 plus cash flow of year 2, which is 615. Okay, divided by discount factor of year 2, 1.1 raised to power 2. So I will add up all of this together. Then I will now net off the cash outflow, CO. The CO in this case is 1000. All right. So again, at the end of the day, when I use my formula, I will get the same answer, except with a small insignificant rounding error. Okay, I should be able to get the same answer as 8 if I use my calculator. So I can either use tabular method to get my NPV, or I use a formula to get the NPV. All right. Now, the next thing we want to do, let's talk about decision rule of NPV. When you calculate NPV, if the NPV is positive, then of course it means that the project is financially viable and should be accepted. But if NPV is negative, the project is not viable and should be rejected. But what if the project has a 0 NPV? Then the company can either accept or reject the project depending on other qualitative factors. So this is basically if you have independent projects. Okay, if you have the independent project. However, where there are mutually exclusive projects, then you accept any project with a higher positive NPV. When you say mutually exclusive project, you have more than one project. Say, for example, you have project A and B. Okay, so that means when you say mutually exclusive, you cannot accept the two. Only one of the project must be accepted. Therefore, anyone that produces a higher NPV is the one that the company will choose. All right. So what do you understand by independent project? What is mutually exclusive project? So when you talk about independent project, it's a standalone project in which it's a standalone project that may be accepted or rejected based on its own merits, which means that if the project is financially viable, then of course it will be accepted. But if otherwise, it will be rejected. Okay, so it's a standalone. It's only one single project. It's a single project. It's a one project. So if that project is financially viable, it will be accepted. But if it is not viable, it will be rejected. So that is independent project. However, for mutually exclusive projects, they are competing projects in which the acceptance of one will prevent or preclude the acceptance of the other. For example, if project X and Y are mutually exclusive, so the acceptance of project X will mean the rejection of project Y. Or if project Y is accepted, project X will be rejected. So that is what is called mutually exclusive project. Okay. Now, the next thing we want to talk about, is as per um, the criteria, some determining factors you must consider when you want to calculate NPV or when you want to determine financial viability of a project using discounting factor or using discounted cash flow method. So there are three key variables that must be present, that must be available whenever you want to ascertain financial viability of a project using discounted cash flow method. The first one thing is relevant cash flow. The second one is appropriate cost of capital, and the third one is the useful life of the project. Now, let's explain them one by one. When you talk about relevant cash flows, not all cash flows are relevant. Therefore, especially when you are writing professional exams, different kinds of cash flow will be given to you on the day of your exam. Not all the cash flows are relevant. Therefore, you have responsibility to be able to identify which of the cash flows are relevant, which one are not relevant, because it is only the relevant cash flow that you must use for the project. For example, you may be given depreciation. Depreciation is not a cash flow and you are given in a question. What that means is that you need to ignore it. You may be given fixed cost. So fixed cost generally is not relevant except it is incremental in nature or except it is attributable or specific to the project. Other than that, you are going to ignore the fixed cost. It's irrelevant. So you must ensure that the cash flow to be used for the project are relevant. Okay. Of course, we are going to discuss relevant cash flows as we proceed at a later date. Then the next one is appropriate cost of capital. Again, cost of capital must be consistent with the cash flows and the risk associated with the project. Money cash flow for money cost of capital, real cash flow for real cost of capital. Every project has its own underlying risk. Therefore, the cost of capital to be used for the project must be consistent with the risk associated with the project. There are two key risks that are associated with a project. One is business risk, the other one is financial risk. All of these risks must be incorporated in the cost of capital for the cost of capital to be appropriate. Then the last one that you need to consider whenever you want to appraise a project, and it is very important, is the useful life. Without the useful life, there is no way you can determine the financial viability of the project. So the determination of financial viability of a project will be almost impossible if any of the three variables that you have here is not there. If any of the three variables you have there is not present, then of course you can't be talking about financial viability of a project if there is no relevant cash flow. You can't be talking about financial viability of a project because you want to discount it, and for you to be able to discount it, you need appropriate cost of capital. Remember, when we did cost of capital, one of the importance of cost of capital is investment appraisal or project evaluation. So you need cost of capital to be able to discount the future cash flow of the project to the present value equivalent. Of course, without the useful life, there is no way you'll be able to determine the discount factor. So you must know, because you want to incorporate the time value of money. So if you don't have the useful life of the project, there's no way you'll be able to do that. Therefore, all these three elements, all these three determinants, all these three criteria, you must consider it before when you are determining the financial viability of a project. Okay, so what other things do we need to talk about? I think discount factor, I've already shown you how to calculate discount factor, and at this level I expected that you know it. However, of course, you may want to determine the discount factor to perpetuity or for indefinite period. So if you are not given cost of capital and you want to determine you are told that the cash flow is to the indefinite period, then the discount factor to infinity is 1 divided by R. Okay, 1 divided by R. Of course, this R is the cost of capital. The R is the cost of capital. Or if you are given the cash flow itself, so you are given the cash flow for year one, year two, then you now told that, okay, of course, the useful life is to infinity. So in that case, you just divide the cash flow by the cost of capital. It will give you the present value to the indefinite period. So that is for that. Then, of course, you may want to determine annuity factor, particularly when you are given constant cash flows. Constant cash flow simply means the same amount of cash flow is what the project will earn all throughout the period of the project. So in that case, since you are given constant cash flow, you need to calculate the annuity factor. Okay, you need to calculate the annuity factor, then you multiply with the constant cash flow to get your present value. Because you can't be doing, if you have a constant cash flow, it will be a waste of time for you to be doing it year on year, year 1, year 2, year 3, year 4, and all of that is a waste of time. Since it's a constant cash flow, just calculate your annuity factor, multiply with the cash flow, and you move on from there. So these are some of the things you need to consider under the net present value. Okay. Then we have discussed the decision rule under net present value. So let's talk about, okay, let's have a short examples of NPV before we move to internal rate of return. Okay, let's have a short example. For example, Applet Limited is considering the purchase of a machine costing 200 million naira, which will generate an annual cash inflows of 46 million for the next 5 years at a cost of capital of 5%. The machine will produce a scrap value of 10,000 naira at the end of year 5. Three things. Remember, I told you there must be three variables. Three variables must be present whenever you want to calculate NPV or determine financial viability of a project. One is relevant cash flow. In our relevant cash flow, we have cash outflow of 200 million naira. This is the initial outlay. We also have cash inflow of 46 million naira. That's what the project will generate. The useful life of this project is 5 years. The cost of capital given to us is 5%. The three variables are already here. All right. We also have a scrap value of 10,000 naira at the end of year 5. So I can decide to either use formula or I use tabular method to get my NPV. Examiner is asking you that you should calculate the NPV of the machine. Then again, should the machine be purchased? So the machine will only be purchased if the machine is financially viable. So if the machine will generate a positive NPV, it will be purchased. If not, it will not be purchased. So let's calculate the NPV. So since there is a constant cash inflow of 46,000 naira, it is more appropriate to use the annuity factor to determine the present value of the expected future cash flows. Okay, the expected future cash flows. So first thing first, I need to calculate. I will go and do my working first. I will go and do my working somewhere to calculate my annuity factor, because the cash flow given to me of 46,000 from year 1 to year 5 is the same amount. Therefore, I will go and calculate annuity factor, and the cost of capital given to me is 5%. So annuity factor is 1 minus 1 plus r raised to power minus n divided by r. Therefore, I will just carry my calculator. Okay, I will carry my calculator. I will then say 1.05 raised to power 5 minus equal minus 1 equal divided by 0.05 equal. That's what gave us 4.329. So that's the 4.329 you are seeing there. That's my annuity factor. So at the final year, examiner gave to us scrap value. We have a scrap value of 10,000 naira. Therefore, I need to calculate discount factor for year 5. Therefore, discount factor is 1 plus r raised to power minus n. So in this case, I'll bring out my calculator to say 1.05 raised to power 5 minus, okay, equal, that's 0.784. That's the 0.784 that we are seeing here. So at the end of I can then proceed to go and calculate my NPV. Like I told you, always use the tabular method. Use the table to calculate your NPV. Forget about the formula. All right. So in this case, I would then say for year 0, after I've designed my table, for year 0, that's where you are going to have the initial outlay, which is the machine cost. The initial cost of the machine is 200,000 naira. Discount factor at year 0 is usually 1. 1 multiplied by 200,000 will give me 200,000. I'm done with that. Again, the cash inflow given to me of 46,000 naira is constant from year 1 to year 5. So I've already calculated annuity factor to be 4.329. Okay, This is the annuity factor, which is 4.329. So at the end of the day, 46,000 naira multiplied by 4.329 will give us 199,134 naira. The last variables I need to consider is the scrap value. The scrap value will occur at the final year of the project, and this scrap value for the project is 10,000 naira. The discount factor at year 5, 10% is 0.784. 0.784 multiplied by 10,000 naira will give us 7,840. Therefore, I want to calculate my NPV. First thing first, I need to add together the present value of cash inflows. Okay, I will add up the present value of cash inflow. When you add the two numbers, that will be 206,974 naira. Then minus 200,000 will give me 6,974 naira. Okay, the next thing I need to do now is to advise whether the machine should be purchased. So here is the advice. Here is the professional advice. The machine should be purchased considering the positive NPV of 6,974 naira. Because the project produced a positive NPV, that means it is financially viable and should be considered. So that's end of the question. Okay. Now let's have another illustration. You know, the first one we solved was constant cash inflow. Let's solve the question that involve irregular cash inflows. Okay, so let's solve this second example. Balablu Limited is a company operating in the entertainment industry. The company is considering committing initial capital of 500,000 naira into a newly found investment opportunity. The project is expected to last for 4 years and will generate the following cash flows. Okay, so the initial outlay of this project is 500,000. All right, there is no scrap value in this one, but the useful life of the project is for 4 years, and we have given the cash inflows. These are cash inflows. All right, therefore we are also given additional information. The scrap value of the project at the end of the useful life will virtually fall to zero. The company intends to appraise any investment undertaken at a cost of capital of 10%. Okay, it is assumed that taxation and inflation will not impact the project. Therefore, advise Balablu on the financial viability of the project. You can see examiner is asking us to advise on the financial viability of the project. We are not told to use NPV or using any other technique. So whenever you are asked to evaluate, assess, advise, or determine financial viability of a project, and you are not told on the method to use, always use the net present value. If the appropriate information is available, always use the net present value to appraise the project. Remember, I told you earlier today that NPV is a technique that is consistent with the shareholders' wealth maximization objective. So at all time, always use the NPV if examiner is not specific. But if examiner has told you to use a particular method, that's what you should use to appraise the project. So in this case, let's solve this question. Okay, so it's the same procedure. I want to calculate NPV. I will go to the question. What's the initial outlay? Examiner has told us that initial outlay of this project is 500,000 naira. So I will come and put it there. That's the initial outlay for year 0. Discount factor, the examiner said we should assume 10%. All right. So 10% discount factor for year 0 is 1. 1 multiplied by 500 will give us 500,000. Then I will now consider cash inflows. The cash inflow for year 1 is 200,000. So discount factor at 10% for year 1 is 0.909. 0.909 multiplied by 200 will give us 181,800. I will then go to the question. Cash flow of year 2 is equal to 180,000. Therefore, 180,000 multiplied by the discount factor of year 2, 0.826, will give us 146,680. Then I will move to year 3. Cash inflow for year 3 is 150,000. Discount factor of year 3 is 0.751. Okay, therefore 150,000 multiplied by 0.751 will give us 112,650. Then the final year, which is year 4, cash inflow is 110,000. Therefore, discount factor for year 4 is 0.683. All right. So 110,000 naira multiplied by 0.683 will give us 73,130. So you add up all the positive present values. Okay, the 4 positive present value, that will give us 518,260. So 518,260 minus 500,000 will give us 18,260. That is the NPV of the project. Examiner is asking you to advise Bala Blue on the financial viability of the project. Of course, since the project produced a positive NPV, then the project is financially viable. All right, the project is financially viable, hence it should be undertaken. That's end of the project. I mean, that's end of the question. It's as simple as that. All right, it's as simple as that. So, for today's class, the next area we want to look at is the internal rate of return. Let's talk about internal rate of return. All right, and we close the class after that. What do you understand by internal rate of return? The internal rate of return is also known as yield to maturity, market discount rate, break-even rate. All right, I mean, you can also call it the discounted cash flow yield. Okay, so it is described at the rate of return that equates the NPV of the future cash flows to zero. Any rate that you use to compute your NPV and produce that produce zero NPV, that is your internal rate of return. Okay, so it can also be defined as the discount rate at which the present value of all future cash flows will equal the initial investment. So it represents the maximum cost of capital that can be applied to finance a project without causing any harm to the shareholders. So, like NPV, the internal rate of return accounts for timing of cash flow and the time value of money, and it is computed using trial and error method. So when you want to compute the internal rate of return, there are basically 4 procedures you are expected to carry out. In fact, 3 procedures you are expected to carry out. The first procedure is to assume 2 discount rates that will produce 2 opposing NPV. I repeat, the first procedure you need to carry out whenever you want to compute the internal rate of return is to assume 2 discount rates that will produce 2 opposing NPV. One discount rate will give you a positive NPV, then another discount rate will produce a negative NPV. Then you now proceed. Step 2 is to proceed to calculate the internal rate of return using the formula on the screen. All right. Therefore, IRR is equal to lower discount rate plus NPV of lower discount rate over NPV of lower discount rate plus NPV of higher discount rate multiplied by higher discount rate minus lower discount rate. Okay, now you can see the sign here is positive. Originally the sign there is negative, but because minus times minus, that's why we are seeing positive there, because minus times minus will change to positive. Okay, that's for that. Then the third step is for you to advise on the acceptability of the project, which will now take us to the decision rule under internal rate of return. For independent projects, accept if internal rate of return is greater than or equal to the company cost of capital. All right. The project will only be considered if the calculated internal rate of return is greater than the company cost of capital. All right. So, of course, it is only then you consider that the project is financially viable. But if the cost of capital computed is, the internal rate of return computed is less than the company cost of capital, that means the project is not financially viable. That is for independent project. For mutually exclusive project, you are going to accept any project with a higher internal rate of return, provided it is greater than the company cost of capital. Say, for example, you have project A, you also have project B. The internal rate of return of project A is 15%. The internal rate of return of project B is 18%. If the company cost of capital, say for example, is 10%, which of the two, project A or B, are you going to accept? Of course, considering the calculated IRR of 15% for A and 18% for B, including the company's cost of capital of 10%, you will notice that project A and B are financially viable because the true internal rate of return is greater than the company cost of capital, but the company cannot undertake project A and B. One of them must be executed. Therefore, you are going to select project B with a higher internal rate of return relative to the company cost of capital. All right, that's what you need to do under mutually exclusive project. Again, do well to read the advantages and disadvantages of internal rate of return so that you have the understanding of that. So let's have a short example for calculating the internal rate of return. Okay. Yes. Caseli Limited. Caseli Limited is considering a project with the following estimated future cash flows. The company cost of capital is 10%. Required, what is the internal rate of return of the project, and advise if the project should be undertaken. So examiner, you have been given cash inflows and cash outflows. Then you are also given cost of capital. The useful life of the project, 4 years, is also given to you. What are you supposed to do? Very simple. I've told you, whenever you want to compute internal rate of return, there are 3 procedures you are supposed to carry out. The first procedure is to assume 2 discount rates that will produce 2 opposing NPV. One discount rate will produce positive NPV, another discount rate will produce a negative NPV. Then you now proceed to step 2. Step 2 says calculate internal rate of return using the IRR formula. Then step 3, you advise on the acceptability of the project. So let's apply that. Now, let me teach you examination technique. We are going to use only one table. Okay, let's use only one table to do this. You can do 2 tables. Like for example, in this case, I assume 15% here, and 15% produce a positive NPV of 6,100. I also assume, so I have to increase the discount rate in order to get a negative NPV. Then I assume 18%. 18% produce a negative NPV of 1980. So what I'm now saying is that instead of doing 2 different tables, you can use only one table to achieve the same thing. This will save your time, especially if you're writing exams. Therefore, let me see if I can manage the space I have here. Okay, let me use this bigger space here. Therefore, I can then say I will create a column for year. Okay. I will create a column for description of items, cash flow, discount factor at whatever percentage, and I will have a column for present value. So in this case, we have year 0, year 1 to 4, 3, then 4. Then, of course, the initial outlay, the cash flow for each year. There is no scrap value. So then I will then go to the question. My cash flow for year 1, for year 0 is 150. That's my initial outlay, 150,000. Let me rewrite that. Okay, that's cash outflow. In year 1 is 60,000 naira. Year 2 is 75,000 naira. Positive cash flow. Then year 3 is 50,000 naira. Then year 4 is 25,000 naira. Okay, now we assume 15% cost of capital. Okay, let me lower this one a little bit. 150,000. So here is at 15%. We assume 15%. Let me do it this way. Okay. So in this case, All right. So instead of drawing different tables, just use only one table. Since they have the same they have the same cash flow, why are you stressing yourself by having two different tables? Just use one. Okay, yeah, I'll get my NPV straight away, net present value. Okay, so in this case, discount factor at 15% for year one, for year zero is 1. 1 multiplied by 150 will give me 150,000. Let me write that. 150,000. Okay, now this is at 15%. Okay, then, so let us calculate the discount factor for year one at 15%. Therefore, 1.15 raised to power 1 minus equal, that's 0.87. This is 0.870. 0.870. Then for year two, 15% for year two, so 1.15 raised to power 2 minus equal, that's 0.756. 0.756. In fact, let me pick it from there. So year three is 0.658. 0.658. Then year four is 0.572. 0.572. So you multiply with the cash inflow. So I would then say 60,000 multiplied by 0.87 equal, that's 52,200. Here will be 52,200. Then 75. I think we have done it before. Yes, 52,200, 56,700. Here is 56,700. The next one is 32,900. 32,900. And the last one is 14,300. 14,300. So I will then get my NPV. My NPV is 6,100. Here is 6,100. You add up all the positive present value, you net off the negative present value. You have 6,100. Then, since my NPV of 15% is positive, I need to increase the discount rate to 18%. At 18%. Okay, so here is 1. Discount factor at 18% for year one is 0.848, 0.847 rather. So 0.847 multiplied by 60,000 will give us 5820. Here is 5820. Of course, here is 150,000. The next one, discount factor for year two at 18%, 0.718. 0.718 multiplied by 75 will give us 53,850. Again, discount factor for year 3 at 18% is 0.609. Multiplied by 50,000 will give us 30,450. The last one, discount factor for year 4 at 18% is 0.516. Multiplied by 25,000 will give us 12,900. When you add up the positive present value, net of 150,000, we have 1980 negative. That's 1980 negative. So you can see, instead of you to have two different tables, just use only one table and you get your answer, you move on to the next step. The next step now is to calculate internal rate of return using the IRR formula. So we assume 15% and 80%. A is the lower discount rate of 15. That's why you see the 15 there. So NPV of the lower discount rate, NPV of 15% is 6,100. So NPV of higher discount rate is 1980. So minus times minus return to positive. All right. Therefore, I will then carry my calculator. Just use calculator. I will then say the NPV of 6,100 plus 1980 equal, that's 8080. That's 8080. Therefore, 6,100 divided by 8080 equal. Then multiply by the difference between 18 and 15, which is 3. Multiply by 3 equal. That's 2.26. Then plus positive, but plus a lower discount rate of 15. That's 17.26. 17.26. Okay, sorry, yes, 17.26. So at the end of the day, you add up, that will give us a 17.3. That's how we got this 17.3. Okay, percent, approximately is 17%. So examiner is asking us to advise. Again, when you want to advise on the basis of internal rate of return, you are expected to compare your calculated internal rate of return with the company's cost of capital. So the company cost of capital given to us in the question is 10%. So and our calculated IRR is equal to 17%, which means the project is financially viable. Look at the decision rule here. Okay, the project's IRR of 17% is higher than the company cost of capital of 10%. Hence, the project is financially viable and should be undertaken. So internal rate of return is very straightforward. So that is it. That is it. So this is how to calculate the internal rate of return. Okay, that's how to calculate the internal rate of return. So at this point, the next we want to do now is to talk about the areas of conflict between NPV and then internal rate of return. Let's talk about areas of conflict between NPV and internal rate of return. What this is saying is that when there are mutually exclusive projects, the decision of NPV may be conflicting with the decision of internal rate of return. This is because NPV may accept a particular project and the internal rate of return may suggest another or may favor another project. So as a result, this is an apparent conflict. And then what is causing the conflict? How can you resolve the conflict? Therefore, the major reasons for conflict between NPV and internal rate of return are in three. The first one is when there's a significant difference in the amount of capital outlay. Okay, when the initial outlay of the projects are different. Let me use an hypothetical figures to explain this. Let me look for space. Okay, let's use this space. Say for example, you have project A, you also have project B. Okay, then the initial outlay of project A is 500 million. Initial outlay of project B is 800 million. All right. Then the useful life of project A, we have year 1, year 2, year 3, year 4, then year 5. Say for example, the cash inflow of project A is 300 million in the first year, followed by 250 in the second year, then 100 in the third year. No cash flow for year 4 and 5, which means that project A has 3 years life. For project B, in the first year, generated annual cash inflow of 100 million, followed by a 150 million cash inflow, then 250 cash inflow, 300, then 320. Okay, 320. Now, let's say discount factor at 10% for this project. Of course, at the beginning is usually 1. Okay, in year 1 is 0.909 826 751 683 621. So these are the discount factor. You will notice that the discount factor at the earlier part is usually higher than 0.909 is higher than the discount factor at the latter part of the project life. Therefore, when you talk about significant difference in the amount of capital outlay, when you look at project A and B, project A has initial outlay of 500 million naira, whereas project B has initial outlay of 800 million naira. The project that has a higher uh, a higher cash outflow, a higher capital outlay may be favored over the project that has a lower capital outlay. So in this case, when there's a significant difference in the amount of capital outlay, this may result in a conflict between NPV and then internal rate of return. The second area of conflict is when there's a difference in the pattern of cash inflow. Okay, when there's a difference in patterns of cash inflow. Now, what do I mean by patterns of cash inflow? When you look at project A, project A has a higher cash inflow at the earlier part, but at the latter part, it starts having a lower cash inflow. On the flip side, when you look at project B generated a lower cash inflow at the earlier part of the project, and at the latter part, it starts generating a higher cash inflow. But when you look at this discount factor at the earlier part of the project is always higher relative to the latter part of the project. Therefore, any project with a higher cash inflow at the earlier part may be favored over the project with a lower cash inflow at the earlier part. So this is what I mean by difference in the patterns of cash inflow. So the pattern of cash inflow of A is better than the pattern of cash flow of B, even though project B starts generating a higher cash inflow at the latter part of the project. But again, by the time you multiply the discount factor for the cash flow at the beginning of the project, you see that, at the earlier part, you notice that that project that has a huge cash inflow may be favored. And the third key difference is coming from when there's a difference in useful life of the project. So the third causes or reason for a conflict between NPV and internal rate of return is if the project has a different cash inflow. So when there's a difference in useful life of the project, that may result to conflict between NPV and internal rate of return. So when you look at this hypothetical project A and B, you notice that project A has 3 years life, whereas project B has 5 years life. So project B has opportunity to recoup more, to get more cash inflow from the project relative to project A. As a result, project B may be favored over project A. So these are the causes or reasons for conflict between NPV as well as the internal rate of return. So I have to use those hypothetical numbers to explain it so that you can understand better. So you can go through all of this to gain more insight. However, how do you then, examiner can ask you, how do you resolve the conflict between NPV and then the internal rate of return? So when choosing between mutually exclusive projects, okay, when choosing between mutually exclusive projects, the project with the highest positive NPV should be undertaken, okay? When choosing between mutually exclusive projects, your decision at all times should be based on the net present value. Why? This is premised on the fact that the NPV criterion is a concept or is a technique that is in alignment, that is in consonant, or that is consistent with the shareholders' wealth maximization objective. So it is generally believed that positive NPV will increase the value of the company, and which will invariably increase the shareholders' value. Okay, it will invariably increase the shareholder, it will maximize the shareholder value. So as a result, your decision at all times should be based on the NPV. In addition to that, the NPV criterion is more reliable relative to the internal rate of return in ranking mutually exclusive projects, because the IRR is kind of subjective. because you are the one that is assuming the discount rate that you are going to use for calculating internal rate of return. It is not verifiable. You are the one that assume it. Therefore, it could be plus minus. So it is not exact. So as a result, IRR is subjective. And then, of course, that's what I'm now telling you, that in any time, whenever you have to evaluate a project, your decision should be based on the on the net present value, except examiner says otherwise. Examiner can say you should advise on the basis of NPV, on the basis of modified internal rate of return, on the basis of project duration, on the basis of payback period or accounting rate of return. So if your examiner is specific, then you advise on the basis of the requirement. But if examiner is not specific on the method to use to appraise the project, then at all time your decision should be based on the net present value. So, and that will be end of the class for today. In our next class, by the grace of God, we are going to be dissecting the modified internal rate of return and then project duration. So that will be the end of today's class.